Hello and welcome back to Accounting 102. As we wrap up the semester, just wanted to give a reminder of what's left as we complete Chapter 14. So lecture today will be on Chapter 14. Homework and a quiz are both due on Chapter 14 on Friday. Also, Friday's the last day to submit any extra credit work. There's some questions I posted that you can answer to get some extra credit if you weren't able to attend uh, the meetings that were there earlier in the semester. So you can take a look at that. Next week is finals week. We do not have a class or a lecture that I will post. You just complete the project for Chapter 14. So it's that continuation of the Waterways company. So have that in by end of day on Tuesday the 12th. I will then get the grades posted as soon as I can after that. If you have any questions, please reach out. One other thing that would be very helpful for me if you all do is complete the end of semester survey. I want to know what works, what doesn't work, the good and the bad, so that I can improve. And thank you for taking the time to do that. You should have received an email. If not, here's a QR code that should take you to the right evaluation. And if you would complete that, I would greatly appreciate it. Thank you. All right, Chapter 14, talking about financial analysis and the big picture. We're going to apply concepts of sustainable income and quality of earnings, apply horizontal analysis and vertical analysis. We've done some of this already, both in 101 and a little bit in this class, but we may not have called it exactly that, so we'll take a look at that in a little bit more detail. And then we'll look at companies' performance using ratio analysis. These are all things that happen day to day within businesses, and you'll use it in the real world as you go out and get jobs and that type of thing. Sustainable income is the most likely level of income to be obtained by a company in the future. Differs from actual net income by the amount of unusual revenues, expenses, gains, and losses included in the current year's income. It's also referred to as continuing operations or ongoing operations, ongoing income. It's kind of looking at what's the normal cycle, what's the normal income that the company will achieve or has achieved going forward. So it's excluding unusual things. We'll talk about some of those today. Information on unusual items such as gains or losses and discontinued operations, components of other comprehensive income are disclosed, and you get a total, but it separates kind of what's the normal, ongoing, and what's the unusual or one-time events. The unusual items are reported net of income taxes. A statement of comprehensive income, we'll see that new statement today, includes net income, so normal net income as we would do it, and then comprehensive income. And other comprehensive income, it's labeled a lot of times. So discontinued operations and other comprehensive income are two major unusual items. Discontinued operations and other comprehensive income are reported net of tax, which means any tax expense or tax benefit is taken out to show it on the statement after that. A disposal of a significant component of a business. This could be a standalone factory, it could be a division, it could be a segment of the business. So just a number of things, a combination of a couple of factories that a company is disposing of or selling, that type of thing. Two things we report for discontinued operations. So one is the income or loss from operations. So the normal running of that business up until the sale date or the disposal date. So whatever the normal income or loss is generated by that component is reported, net of tax, of course. And then what the actual gain or loss is on the disposal. So if it's a sale, did you sell it for equal to or less than the book value or more than the book value, and then you can calculate gains and losses of that, again, net of tax. So look at an example. During 2027, Arco Energy has income before income taxes of $800,000. During 2027, Arco discontinued and sold its unprofitable chemical division. The loss in 2027 from chemical operations, net of $40,000 income tax savings, was $160,000. So they're saying what the amount of the income tax savings was. They're stating the loss net of that. So really it was a $200,000 loss. They got a benefit of $40,000 in tax savings. So 160 is the net. Then they had the loss and disposal of chemical division, net of $20,000 income tax savings. Again, showing what that income tax savings is, and then the net number was 80,000. So a loss of 100,000, 20% income tax, so 20,000 tax savings, 80,000 net. The way they show it on the income statement is as this. So we have our income before taxes, normal income statement down to that point, 800,000, income tax expense, 20% again, 160,000. So we have income from continuing operations. Then we have the discontinued operations listed there, the loss of the operation of the division, and then the loss on the disposal. And then we have the total net income. Comprehensive income is the sum of net income, similar to what we just looked at, and other comprehensive income items, such as certain gains and losses that bypass net income. So there are things, and if you take a intermediate accounting, you'll run into some of these items where the unrealized or gains and losses don't hit the income statement, but they do impact equity. The most common example is unrealized gains and losses on available for sale debt securities. So if you buy bonds in another company and the market value changes and you're holding them as available for sale, we'll get into an example there. That is considered other comprehensive income. Doesn't show up on the income statement until you actually sell the securities. But then it does impact equity on the write up and write down as you're marking it to market value. So let's look at an example. During 2027, Stasi Corporation purchased IBM bonds for $10,500 as an investment, which it intends to sell sometime in the future. So if you buy bonds in another company, in this example, you can either hold it as planned to hold to maturity, which means you don't plan to sell it at all until the bonds mature. Doesn't mean you can't sell it if something changes in the future, but that's just your intent going in. You can hold it as a trading securities. That means you're going to actively be looking to sell. So it's more of a short term. I'm planning on selling this as soon as the market hits right. And then the third way is available for sale securities, where you're going to sell it before it matures, but you're not actively looking for the right time. It's just if you need some extra cash, that's when you'll sell it. Okay, so in this case, Stasi intends to sell it sometime in the future. At the end of 2027, they were still holding the investment, but the bond's market price was now $8,000, so less than what we paid for it. Stasi is required to reduce the recorded value of its IBM investment by the unrealized loss of $2,500. Should Stasi include this $2,500 unrealized loss in net income? So if it's held to maturity, you don't mark it to market value because you plan on holding it long term until it matures. But if it's trading securities and available for sale securities, you mark the asset to the market value, in this case a write down. Just the treatment of where you put the loss depending on how you hold it. So trading securities, actively looking to sell it, it goes on the income statement and other expenses and losses. So immediately into the income statement, and you're recognizing that loss. If it was a gain, you would recognize the gain as well. Available for sale securities, the unrealized gains and losses are reported net of tax as other comprehensive income on the comprehensive income statement. So there's actually a journal entry, and it debits, or in this case, a debit because loss, an account that is an equity account, but it doesn't go through net income, but it reduces equity. And the comprehensive income statement looks like this. We start with net income from the income statement. So it's available for sale. So we show other comprehensive income, the loss, net of the tax savings, and then we get a total comprehensive income. And then in the equity section of the balance sheet, we show this information. So common stock and retained earnings as normal. We get our total paid in capital. And then we have another line called accumulated other comprehensive loss. In this case, it's just the one item, $2,000. If we held it for another reporting period and we had a gain or a loss, it would adjust this number, and that accumulated would be the net of what happens there. So now let's look at it all together. We have, this is Pace Corporation. We have net sales, cost of goods sold, gross profit, normal income statement items, operating expenses as normal income from operations, other revenues and gains, other expenses and losses to get us income from before taxes. We then show the income tax expense on that portion of income. And then the subtotal is income from continuing operations. We have discontinued operations, so we show that next. The loss on the operations, in this case, net of tax benefit. We had a gain on disposal, so we had tax expense. So our gain was reduced by that income taxes we had to pay, so $40,000 net. Total from the discontinued operations was a loss of $8,000, and then we have our net income. So those discontinued operations are actually reported on the income statement as part of net income. Then we have the statement of comprehensive income, where we start with that net income and then add or subtract any gains and losses or other comprehensive income, in this case, an unrealized gain on available for sale securities. We had to pay record income tax on that, so we have an expense of $3,000, so $15,000 gain, $3,000 in taxes, so $12,000 net, and then our total comprehensive income listed at the bottom. Another item to consider is our changes in accounting principle. So it occurs when the principle used in the current year is different from the one used in the preceding year. So an example, if we change our inventory costing methods from FIFO to average cost, for example, we would disclose that and call that a change in accounting principle. Accounting rules permit this change when management show that the new principle is preferable. So if something happens in the business or some change happens that this new method or this new principle is better for reporting our numbers, management can make that decision. Typically it's not common, and you can't pick a different method one year and then a different the next to whatever fits that year. You have to show a real reason why it's a better principle or a better method going forward, and then change to that method ongoing. And then if you do make a change, they report most changes in accounting principle retroactively, which means that when you produce your financial statements, a lot of times you have comparative years. However many years you show, you have to go back and restate those prior years as if you would have made that change from the beginning of the time you're showing. So if you show 3 years of income statement and you only made the change in the current year, you would restate the prior 2 years with that same change so it can be comparable. It will not be the same as what we showed in the financial statements previously. So quality of earnings. High quality of earnings provides full and transparent information that will not confuse or mislead users. So alternative accounting methods, variations among companies in the application of GAAP may hamper comparability and reduce quality of earnings. For example, if one company uses FIFO, the other LIFO, it's going to be hard to compare because they're going to have different results, especially in times of inflationary times where the LIFO is going to have a higher cost of goods sold than under the FIFO method. So it's hard to compare. Straight line versus declining balance depreciation. Again, especially early years of the asset's life, you're going to have dramatically different depreciation expense, even if you had the same investment. So the quality of earnings is looking at do you disclose all of that information? Are you transparent in how your accounting works so that you can make informed decisions and make any adjustments that you think might be necessary as you're analyzing different companies. Sometimes companies use pro forma income statements. So if your stock is publicly traded, you're required to present their income statement following GAAP. So U.S. listed companies must present their statements following U.S. GAAP. But many companies also have been reporting pro forma income that usually excludes items that the company thinks are unusual or non-recurring. So they may, even if it's in the normal operations, they may call out, well, we did this special sale, so we had extra sales that aren't ongoing, or most of the times it's extra expenses, one-time expenses, bonuses, or something like that. Maybe they might call out and try to exclude it in their pro forma income statement. If a company does that, they must also produce the GAAP financial statements and then a reconciliation on how they went from the GAAP statement, in this case income statement we're talking about, to the pro forma income statement, and show that walk as best they can. So then many analysts and investors are critical of this because it's usually done to make a company look better. So it's kind of saying you're looking better than you actually are. And that's the debate of, are you really, or is it truly a one-time item? You know, if a company does it once every, few years, or just the first time they did it, maybe it's not a big deal. If they're doing it every year and excluding different things every year, then you would question, is it really a one-time item if it keeps repeating? Improper recognition. So most common abuse is improper recognition of revenue. So one example is channel stuffing, Bristol Myers Squibbs. I think this is a case where they sold into, they had high sales into the distribution channel. The end users, the consumers, weren't pulling through the sales from that distribution, so the distribution channel was loaded up with inventory. Bristol Myers looked good because they were recognizing those sales to the distribution, but it really was just sitting there. That's kind of not a good quality of earnings because it's kind of misleading on what you're doing. Typically what happens then is the following year you're not going to have repeat sales unless you continue to stuff the channel every year, which is sometimes hard to do. Another practice is improper capitalization of operating expenses. So WorldCom is probably the most famous. It's a telecom company that was formed and then started buying out smaller telecom companies. They had decided, because the accounting systems were disjointed and not consolidated yet, to take some of the expenses they were incurring, which should have been annual operating expenses, and then capitalize those and amortize it over some life of the contract, which isn't the proper accounting. So their income looked better, but then it caught up to them, and they were, had some a bad press and got in trouble for doing that. And then failure to report liabilities, Enron is the most famous one there, where they had what is called off-balance sheet financing, where they created some joint ventures. Um, Smart people working on it, and they had some good ideas. It just was, skirting the accounting rules, and they weren't following how they were supposed to recognize some of these joint ventures and partnerships on their books to make their books look better. But Enron was really on the hook for those liabilities that they weren't disclosing to shareholders. They ended up getting caught, and the liabilities coming due, and a lot of people losing a lot of money because they invested in Enron, especially some pension funds and teacher pensions and that type of thing. So pretty not a good situation. So let's look at another example. Air Corporation in 2027 had the following amounts. This is all before tax effects. So the income from operations, 400,000, unrealized gain on available for sale securities, 100,000, loss from operation of discontinued flour division, 50,000, loss on disposal of discontinued flour division. Income tax rate is 20%. Prepare a partial income statement beginning with income before income taxes and a statement of comprehensive income. So the first thing we would do is show on our income statement, starting with income from before taxes. We would have the normal line items above that to get to that item, but we'll skip it to there. So we'd show that as 400,000. We would then show the income tax expense on that. So 20% of 400,000 is 80,000. Subtract that, we get 320,000 income from continuing operations. Then we would show the two items in our discontinued operations. The loss from the operations, 50,000 minus 20% taxes is 40,000, and then loss on the disposal, 90,000 again, less 20% taxes gives us, or the tax savings actually, gives us 72,000, so 112,000 of the loss on discontinued operations. So our net income is 208,000. We then show the unrealized gain on available for sale securities, again net of income taxes, on the statement of comprehensive income. So we carry down our net income number, show that unrealized gain, and so our comprehensive income is $288,000. Now we're going to horizontal analysis and vertical analysis. Investors are interested in core sustainable earnings of a company. We just talked about some of those in the quality of earnings in the last section. And then they're also interested in making comparisons from period to period. So three types of comparisons we'll look at: intra-company, so within the same company; inter-company, between two companies; and then comparing a company to industry averages. The basic tools that we're going to use for that is horizontal analysis, vertical analysis, and ratio analysis. Okay. Like I said earlier, we've seen a lot of these a little bit. We may not have just called it these specific things, so hopefully some of this will be review, and you can see how it all works together. So horizontal analysis, also called a trend analysis, looks at a series of financial statement data over a period of time. So 2 years, 3 years, 4 years, 5 years, whatever the right time frame is to kind of look at that. I know my last job, we had a statement that we would look at, especially during budget and long-range plan time. We would present. We had, I think, what did we have? We had 10 years of data showing, and our CEO would ask us questions about, hey, you looked a lot better back in 2018. What's the difference? And we would use some of these techniques, these trend analysis or horizontal analysis, to kind of look at different ways to try and explain the change in results. So the purpose is look at an increase or decrease in a dollar amount or a percentage. So it can be expressed as either, or a lot of times both. So look at an example here. I'm hitting the button too many times, sorry. Chicago Cereal. We have a balance sheet for 2 years, 2027 and 2026. Then we show the change. So increase is a positive number, decrease would be a negative number, both in dollar amount and percentage. Okay, and the percentage is simply the dollar amount change divided by the base year, which is the oldest year. So in this case, 2026. Presentation of these usually has the current year first, and then going across the right, the years decreasing. So that's just standard. If you picked up an annual report, you would see that same kind of format typically showing. So the first column is the current year. So we can look at some different data and make some analysis based on this statement. What you would do is look in the current asset section, or in the asset section, the current assets increased 290,000 or 11.9%. You can do the same for property assets, increased 174, probably invested in some property, plant, and equipment. Other assets increased 219,000 or 4%. Do the same thing for liabilities and stockholders equity section. So you can see what the changes were. We can do the same analysis or the same idea with, sorry about that, income statement. So we have net sales, gross profit, selling administrative, so the whole income statement. Again, 2 years of data show the change, increase or decrease during the year, and then the percent change. Again, we can look at the analysis. So we see net sales increased 869,000 or 8%. Cost of goods sold increased 515,000, 8.5%. So just looking at the numbers, may not be able to tell really, is that did I control my cost compared to what my sales increased? But if you look at percentages, you can see that my cost went up more on a percentage basis than my net sales. So I had increased cost for some reason, so I may want to look into that. My gross profit increased 7.3%, although my sales increased 8%. That's another thing that, that's the same type of thing. You'll need to look at that. Selling and administrative increased 8.2%, kind of in line with the increase in sales. So not great. You would think you would have some increases, but it may not be the same as your increase in sales. What you want to try and do is leverage that so you can grow your bottom line. And then net income increased almost 10%, which is a lot more than the gross profit or in our net sales. But if we looked at it in detail, it was really the income tax expense decreased, which increased our net income. The other way to look at it is a vertical analysis, sometimes called a common size analysis. It expresses each financial statement item as a percentage of a base amount. We've seen this on the income statement before, so we'll see it again here. Balance sheet, we could express the line items, for example, current assets as a percent of total assets. So total assets would be the base. That's typically what they do. Income statement, sales would be the base, so we would look at selling expenses as a percentage of net sales. So here's what it would look like for the balance sheet. Again, we have 2 years of data. We have the percent with the total assets being the base, 100%, and then also liabilities and stockholders' equity total being 100% because those equal, and every other line is a percentage of that. On the income statement, some analysis, sorry. So you can see some changes. The increase on the dollar amount was 290, but the percent of total assets was 1.2% increase. Property assets decreased as a percent of total because current assets increased, and maybe a depreciation to reduce our property assets as a percent. The retained earnings increased, and total stockholders' equities increased from 19.3% to 22.1% of the total. So that increased more than liabilities. And then on the income statement, net sales is the base, 100%. We've seen this before as percent of cost of, the cost of goods sold or margin percentage is gross profit percentage, net income percentage. So we can see those data and compare the 2 years. So you're kind of combining the horizontal and the vertical analysis together. We can see our gross profit decreased slightly, 0.2%. But our net income increased 0.2%. So some things are going on there that we might want to dive into. And this kind of on itself gives you information to then look at the next level. So here's some analysis that you would look at. Cost of goods sold increasing as a percent of sales. Selling and administrative, again, increasing as a percent of sales, and net income increasing as a percent of sales. So you can dig into some of those items to help explain better why that is happening. So that was all intra-company. Now if we look at intercompany, using the vertical analysis, we've got Chicago Cereal that we looked at already compared to a competitor, Giant Mills, and we can compare the two companies. So here's the data, and then what some of the comparison tells us. Chicago sales are much less than those of Giant when you look at it on a dollar basis, but using the vertical analysis, you eliminate that size difference. So you can compare different size companies and make some analysis based on that. So Chicago has a higher gross profit percentage compared to Giant. So 44% for Chicago versus 35.6. So they're doing a good job controlling their cost of goods sold. But Chicago's selling and administrative expenses are 28.1% of net sales, while those of Giant are 19.4%. So Chicago is spending more in selling and administrative than their competitor, which leads to net income percentage being lower for Chicago than for Giant. So let's look at this and do some analysis on our own. We have some summary financial information for Rose Patch Company, current assets, planned assets, and total assets. Compute the amount and percentage changes in 2027 using horizontal analysis, assuming 2026 is the base year. So we would take the 2027 numbers minus the 2026 numbers to get the dollar change, then take that change divided by the 2026 numbers to get the percentage change. So we can see current assets increased 54,000 or 30%. Planned assets went from 420 to 756,000. So $336,000 change, 80%. And my total assets increased $390,000 or 65%. Finally, we'll look at analyzing a company's performance using ratio analysis. So ratio analysis expresses the relationship among selected items of financial statement data. We have liquidity ratios, we have solvency ratios, and profitability ratios. Okay, we'll look at each of these and get into what the different sets of ratios mean and how we can use them. A single ratio by itself is not very meaningful. We use different types of comparisons. Again, intra-company, comparing 2 years for the same company, industry averages, looking at what the industry average is and how we compare to that, and then finally the intercompany, so against the competitor, how does that look? So here's the data we're going to use for Chicago Serial. We have 2 years of data, our income statement, our balance sheet, our cash flow statement, and now let's get into the ratios. So liquidity ratios measure short-term ability of the company to pay its maturing obligations and to meet unexpected needs for cash. So we're going to look at kind of our current assets and how liquid we are. Can we, in our current liabilities, can we pay our current assets with our current liabilities, that type of thing. So short-term creditors such as banks and suppliers are particularly interested in these liquidity ratios. So the first one is the current ratio. So we take current assets divided by current liabilities. So for Chicago Serial 2027, we get 0.67, which means that they have 67 cents of current assets for every dollar of current liabilities. All right. Compared to last year, it's a higher number, which is improving this ratio from 0.60 to 0.67. This 0.67 is in line with our competitor, but lower than the industry average. Okay. I would not be overly concerned necessarily with this. It says we do not currently have enough current assets to pay our current liabilities that are going to be all due in the next year. So we're going to have to generate more cash either through sales or some other financing to make sure we meet those payments. But our trend is going up. It's in line with our competitor, so it could just be cyclical. Not much to worry about there. Accounts receivable turnover. It measures the number of times on average the company collects receivables during the period. So we'll take our net credit sales, so excluding any cash sales. So it's just the stuff that goes on into accounts receivable. So we take those net credit sales divided by our average net accounts receivable. And we see that for 2027, it's 11.9 for Chicago Serial. It was 12 last year, so pretty close to the same. So that means on average 12 times a year, 11.9 times a year, we're collecting our full accounts receivable balance. So we're averaging right around $1 million, $1,000. So we're collecting that 12 times a year. So Giant Mills 12.2, so in line with that, and we're higher than the industry average of 11.2. Okay. Now that we have our turnover, we can take 365 divided by that turnover number, and we get the average collection period. So this is the number of days it takes to make our collections. So we say it's 11.9 times a year. 365 divided by that gives us 30.7, which makes sense. 12 times a year is roughly once a month, which is roughly 30 days. So 30.7 days we're collecting our receivables. Okay, again, trending up from last year, so a good sign there. Higher than our competitor slightly, but then lower than the industry average again. We can do a similar analysis on inventory, so our inventory turnover. So cost of goods sold divided by average inventory. Receivable turnover, we used sales. For inventory turnover, we're using cost of goods sold. So this is the number of times we turn our inventory. So it's basically going from cash to cash when you buy your inventory to when you um, are selling your inventory. So 7.5 times a year, down from last year slightly, in line with our competitor, higher than our average. And then again, we can take this 365 divided by that number, and we get the number of days in inventory. So 48.7 days. So roughly, if we didn't produce anything else, we could make sales for 48, almost 49 days, um, and on average meet our sales. Again, it's going up, so we're holding a little bit more inventory. That's what that means, but we're still lower than our competitor and lower than the industry average. Okay. What this doesn't tell us, though, is do we have the right inventory? So you want higher turnover, lower days in inventory, so you know can guard against obsolescence. You want the right amount so that you can make the sales when when the customer wants it. You would have to do a further analysis and break this down into product categories and or even the SKU level to really see where operationally you would do it. So it's a good measure of the company overall, but operationally you would have to dissect this more to make sure you're running your operations the right way and that you're producing the right inventory to be sold. So that was liquidity. Now we'll look at solvency. This is the ability of a company to survive over a long period of time. So looking at some longer periods than just the short-term liquidity. So debt to assets ratios times interest earned provide information about debt paying ability. And then the free cash flow provides information about solvency and ability to pay additional dividends and invest in new products. So the first one is the debt to asset ratio. Total liabilities over total assets. So it's very similar to our current ratio, except now we're total of liabilities and assets. Okay, so 78% for 2027, down from 81%. So this provides some indication of company's ability to withstand losses without impairing the interests of its creditors. So can I pay off my liabilities with my assets, if I need to? So higher the better. Okay. As with all of these, you don't want to go to too many extremes. You can get them too high or too low if that's the goal you're trying to do. So you got to find the right spot. So you can see we're higher than our competitor and higher than the industry average. So we may be able to reduce this a little bit, take on a little bit more debt, reduce our assets potentially, and still be in line with the industry. The next one is the times interest earned, which takes our net income, adds back our interest expense, and adds back our income tax expense from the income statement. Divide that by our interest expense. Okay, this gives us, if we take our income excluding taxes and interest, how many times we can make our interest payments. Okay, so 5.8, down a little bit from 6, fine. We're higher than the industry average of 5.5, but lower than our competitor. So you would have to look at, do they have, are they carrying the same amount of debt? Is their interest expense lower, or do they just have more income compared to that? So some more analysis is needed. And then next we have our free cash flow. This is a very common measure that almost all companies use. So if you listen to any earnings statements or read any financial statements, you're going to see a reference to free cash flow, almost guarantee it. Again, it's a non-GAAP measure, but it's very common. And it's calculated by taking net cash provided by operating activities, so that first part of the cash flow statement, and then subtracting the capital expenditures from the investing section. So just the spending of capital, not any retirements or anything else from that section. And then from the financing, taking the cash dividends paid from there, subtracting that, and that gives us the free cash flow. Okay, so this is kind of thought to be a better measure of if I take my operating cash and pay for my capital expenditures and pay my dividends, do I still have money so I can invest still in the business, or I'm being able to pay future obligations, that type of thing. So people feel this is a better measure. Again, we would have to show this calculation to reconcile back to our GAAP cash flow statement, the one that we saw earlier for Chicago Serial, and you would just show that calculation within the notes of the financial statements. And then finally, profitability ratios measure the income or operating success of a company. Income affects the ability to obtain debt and equity. Liquidity and ability to grow. Creditors and investors are interested in evaluating their profitability, and analysts use profitability as ultimate test of management's operating effectiveness. What we'll look at here is ultimately the return on common stockholders' equity, which is from our return on assets and our leverage, debt to assets ratios that we already looked at. And then from return on assets, we'll look at profit margin and asset turnover. So the return on common stockholders' equity is our net income minus preferred dividends, if any, divided by average common stockholders' equity. We get a percentage. We see Chicago Serial is up from last year, higher than competitor, and definitely higher than industry average, over twice the industry average, in fact. So the return on common stockholders' equity shows how many dollars of net income the company earned for each dollar invested by the owners. Okay, again, higher, you're doing better, making a return on your stockholders' investment. Return on assets is our net income over average total assets. So it measures the overall profitability of assets in terms of the income earned for each dollar invested in assets. So Chicago Serial's doing well at 10%, up from last year, higher than your competitor and higher than the industry average as well. Next is the profit margin. So that's net income divided by net sales. So we've seen this when we did the vertical analysis again, that same calculation, 9.4% up from 2026, higher than our competitor and higher than our industry average. So what percentage of each sales dollars falls to net income is what this measures. And then our asset turnover is next. We have net sales divided by average total assets. Say 1.07 up from 1.02, higher than our competitor, higher than industry average. So it measures how efficiently the company uses assets to generate sales. So you're generating more sales than your average assets if it's above 1. So you're really leveraging those assets. And then we can look at this all together. Our profit margin times our asset turnover equals our return on assets. So our profit margin is net income over net sales. Multiply that by net sales over average total assets to get asset turnover. That leaves us with net income over average total assets, which is the calculation for return on assets. But this just shows you can, if you have two of the ones, you can calculate the third without having the details of them. So if a problem gives you profit margin of 9.4 and asset turnover of 1.07, You multiply them together and you can get your return on assets without having to have all the detail behind that. Gross profit rate, again, we've seen this before. Gross profit divided by net sales. So we've looked at this in different scenarios, and again, when we did the vertical analysis. So are we maintaining our selling price above the cost of goods sold? So if we see increases in sales or increases in cost, are we passing that on to our customers and showing a increase in net sales as well? Earnings per share for a public company, this is a key measure. It's net income minus preferred dividends divided by the weighted average common shares outstanding, which could get complicated in calculating that, especially in years of having treasury stock transactions. The weighted average shares outstanding is a little bit hard to complicate. Luckily, we're not getting into that here. So for Chicago Cereal, 2.63 was our earnings per share in 2027, up from 2.4, a little bit lower than Giant Mills, and there's not an industry average for some reason. So it's the net income earned for each share of stock. So if you have common stock in this company, take your number of shares, time this, and that's what your earnings were for that period that was attributed to the stock that you own. It's also what analysts typically predict. So they'll have a prediction of what the earnings per share will be, and then when a company announces earnings, their stock is going to go up or down depending on how close they are to those earnings and other things that are in the press release. Price earnings ratio takes our market price per share divided by earnings per share. So it reflects the investor's assessments of a company's future earnings. So if I'm, think this company's going to earn more, I might bid up the price of the stock. More people may want to buy it. So their price earnings ratio is going to go up. And it's another way to kind of compare companies in the same industry. So we're Chicago Cereal's at 20.1 compared to 24 for Giant Mills. So it seems like investors are valuing Giant Mills a little bit more. Their stock compared to their earnings per share is higher, and the industry average is really high. So kind of interesting on that. So you may see that Chicago Cereals is a bargain to buy. They've got some good results. Some of the other ratios are looks like it's in good shape, but their price to earnings ratio is lower than industry, so they may have some growth coming in their stock price. And then finally, the last one is the payout ratio. It's the cash dividend paid divided by net income. So we get a percentage here. This is the percentage of earnings that are distributed as cash dividends. So 43%, a little bit lower than 2026 at 45, but nothing to really be concerned about. It's lower than Giant Mills, so if you want dividends, you might want to think about Giant Mills. They're paying out a higher percentage of their income. So as long as their income is growing there, you would think that their dividends would grow as well, but we're paying out more than our industry average. So a lot of information to kind of look at how you can analyze a company and that type of thing. That's it for Chapter 14. Again, homework and the quiz are due Friday. Next Tuesday, we just have the project due. I hope you've enjoyed the semester. Good luck to you all, and hope to run into you in the future. Thank you.